start. Good evening, everyone. A very warm and cordial welcome to all our distinguished dignitaries, respected speakers, and participants who have joined us today for this insightful webinar. Myself, CMA Rup Bishwas, and it is indeed a privilege for me to anchor today's session on behalf of the Banking, Financial Services, and Insurance Board of the Institute of Cost Accountants of India. We are gathered here today to deliberate on a highly significant and contemporary topic, impact of global uncertainty in international trade. Today we have with us our chairman CMA Chittaranjan Chattopadhyay sir and our speakers CMA Dr. P. Shivarama Prasad sir, former Assistant General Manager, State Bank of India, CMA Nijay Gupta sir, Forex expert, and CMA Mrityunjay Acharji sir, General Manager, New Maligarh Refinery Limited. He will be joining soon. Before we formally begin the proceedings, it is customary to play the ICMAI anthem. May I now request all participants to kindly join in as we play the anthem of the Institute.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय
मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय ॐ शान्ति शान्ति शान्ति।
I now request to Chairman of BFSI Board, CMA Chittaranjan Chattopadhyay sir, to deliver his inaugural speech. Sir, over to you.
Namaskar. Namaskar. Very good afternoon to you all. Respected distinguished speakers, esteemed members and participants. It's my pleasure to welcome you all to this important webinar on impact of global uncertainty in international trade, organized by the Banking, Financial Service and Insurance Board of ICMAI. As you all know, in today's highly interconnected world, international trade is no longer influenced only by demand and supply conditions. It is increasingly shaped by geopolitical tensions, supply chain disruptions, currency volatility, insurance pressures, freight risks, sanctions, and shifts in global policy environments. This makes today's topic specially relevant for bankers, finance professionals, insurers, exporters, importers, and all stakeholders connected with cross-border commerce. Global uncertainty has a direct bearing on trade finance, foreign exchange exposure, shipping and logistic costs, credit risk, and the stability of business operations. For banks and financial institutions, this means greater caution in assessing trade transactions, stronger monitoring of counterparty risk, and more careful structuring of working capital and guarantee facilities. For business, it means the need to build resilience through better hedging, diversified markets, prudent inventory planning, and disciplined financial management. In this environment, the role of cost and management accountant becomes especially important because sound analysis and timely risk recognition can help organizations remain stable even when markets are under stress. The implications are equally significant for the insurance and reinsurance sector also. When global trade becomes uncertain, the exposure to marine risks, cargo disruptions, policy exclusions, claims volatility, and reinsurance cost pressures also rises. The ability to price risks correctly, ensure adequate coverage, and maintain financial discipline becomes critical. Today's discussion will therefore help us understand not only the economic effect of uncertainty, but also the practical responses required from the financial ecosystem. The contribution of CMAs in this context is particularly valuable. Our profession is trained to look beyond surface trends and evaluate the true cost, risk, and sustainability of business decisions. CMAs can support organizations by strengthening trade cost analysis, working capital planning, foreign exchange exposure management, compliance systems, and internal controls. At the institutional level, CMAs can help banks and financial firms improve credit appraisal, risk assessment, product structuring, and profitability management in trade-related transactions. At the enterprise level, they can guide business in protecting margins, improving decision making, and building resilience against external shocks. The BFSI board of ICMI remains committed to building professional capacity in these emerging and challenging areas. Though through these webinars, publications, and structured learning programs, the board continues to provide members with practical knowledge that connects regulatory understanding with market realities. Such initiatives help professionals stay informed, relevant, and prepared to serve industry and society with greater confidence. We have also published a robust third and revised edition of Aid Memo on Infrastructure Financing and request the members to purchase the hard copy, as we have also uploaded the soft copy of the publications. I am confident that today's webinar will offer valuable insights on how global uncertainty is reshaping international trade and how finance professionals can respond with foresight, discipline, and professional excellence. And this excellence will definitely take them to the height of success. I thank our distinguished speakers for sharing their expertise and wish all participants a highly engaging and enriching session. Please be engaged with our all same speakers and you get your any queries to be replied by them. Thank you. Jai Hind.
Thank you, sir. Thank you. Now, allow me to introduce the first speaker for today's webinar. It is indeed a privilege and a matter of great honor to introduce our esteemed speaker for today's webinar, CMA Nijay Gupta, sir. CMA Nijay Gupta, sir, is a seasoned forex, treasury, and trade finance expert with over 4 decades of extensive experience across leading Indian and international banks, corporates, and financial institutions. A practicing cost accountant and consultant at N.K. Gupta and Company. He is also associated with professional bodies such as a Institute of Cost Accountant of India and the Indian Institute of Banking and Finance. He holds CA-IIB qualification along with a postgraduate diploma in a law of international institutions from the University of Delhi. Mr. Gupta has held senior leadership roles including Deputy Chief Executive at Krung Thai Bank, Vice President at Bank Muscat, and Head of Treasury at Abu Dhabi Commercial Bank, Dhanlakshmi Bank, Antwerp Diamond Bank. His expertise spans integrated treasury management, forex market, trade finance, asset liability management, and setting up treasury and banking operation for banks and corporates. As a consultant, he has advised on treasury setup, payment banks, money transfer businesses, and international trade finance operation, working with global institutions and projects across India, UAE, Oman, East Africa, and Southeast Asia. He has also contributed to banking and fintech projects with organizations such as Infrasoft Technologies and Datamatics. A highly regarded trainer and a visiting faculty, Mr. Gupta has delivered programs for premier institutions including ICAI, BSc institutes, NMIMS, NSE, and leading business schools. He regularly conducts training sessions and workshops for banks, MNCs, and industry bodies on treasury, risk management, forex hedging, international trade finance, and banking operations. He is a frequent speaker at national and international forums, contributing significantly to capacity building in the BFSI sector and advancing professional knowledge in treasury and international finance. I now warmly invite CMA Nijay Gupta sir to share his thoughts and insights with us. Thank you, sir. Sir, what to you?
Dada, can I share my?
Yes, sir. Yes, sir. Please share your PPT. Sir.
Dada, are you able to see?
Yes, sir. It is visible.
And are you able to see this also?
Yes, sir.
Right? Okay, great. Hi, good evening, everyone. Thank you, Dada. Thank you, Chetan sir. And thank you, everyone, for giving me an opportunity to speak to you. Okay? On today's burning topic of global uncertainty in the international trade. I think everybody must be tracking and must be watching what's happening right now and what is going to happen in the next postponed 10 days more, right? Okay. So the area I'm going to talk is the international trade bank. This is balance of payment management, which is done by the Reserve Bank of India. Then management of forex reserve by RBI. Then the foreign exchange volatility and impact due to FPI ECB flows on exchange rate movements. Hedging strategies for managing currency risk. Impact on treasury. RBI banks, NBFCs, corporates, HNIs. Impact on interest rates and bond revaluation. And the FEMA 99 regulations, which is going to be amended from 1st October 2026. The latest operation which is going to happen for the benefit of each one of you. And then I would like to give some time on FX retail platform of CCIL India, which is very useful for all the people who are into the international trade business. So just to share on screen with you, what's happening today, like closing Indian rupee rate, USD INR is 94.81, something like that. And we have seen the Sensex coming down like anything today. 1,700 points came down to 73,583 and the Nifty at 22,890. Gold come down to $4,400. Brent is about $110. So this is just the market I shared with you. Okay. Now let me share my points. So what exactly is happening right now? See, we have to understand the need and importance of doing the trade. So, no country is self-sufficient. And now we can see, it is well seen that we are not at all self-sufficient. Because most of the goods, either we are importing with China, or now we are seeing what is happening with the oil, gas, fertilizer, petrol, everything. So there is a lot of dependency, and not only for us, it's for many countries put together. And the next question comes when you are, okay, fine, that is impacting your trade deficit. So what's happening right now, I'll show you some numbers. The mechanism to settle the international trade through foreign exchange. So when we started with the barter, okay, if you see the olden days, when we were goods for goods, then we moved to the metal. Now presently is the SWIFT. But still you will find about 85% of trade is settled in American dollar. Despite there was an attempt by some BRICS countries for de-dollarization, but that was no use, because America would not like their importance to be reduced. Then what we have seen, which nobody knew earlier, which has been running by the government by last 70 years, the issue of sanctions, like on Russia, Iran, then tariffs, okay, the new thing everybody is knowing now, and the free trade agreements. Unfortunately, we lacked a lot in the FTAs. In fact, if you ask me last 12 years, no FTA has been signed by the government. They claim something that we had done with the UK, you had done with some US, but it's all bogus, let me tell you. Nothing has been done. Okay? So this is the major issue, which could have been done when so many things are being done. Now the major issue is happening with the geopolitical situation, which started with Sri Lanka, then Bangladesh, then Nepal, then in between Gaza, because they want to develop something like Trump Gaza. Now this latest thing is US-Israel war on Iran. This could be called up. And the importance of ECGC. We need to cover the trade credit insurance. Okay. And now the next question is, how do you hedge your risk? Either through PCFC, PCINR, forwards, futures, options. So what's happening? Even if you as an exporter, you take PCFC today at 94.81, you are not sure next week because so many holidays. The rupee may touch 97, 98 also. So I've given a statement for this. Ab ki baar, so ke par. Because the entire Calcutta and all, West Bengal, everybody is in election mode. So I said, why not give a statement here? Ab ki baar, so ke par. That is for USD INR. Okay. So quite possibly we might cross 100. Let me tell you, when I started working in the foreign exchange, it was 7 rupees 50 paisa per dollar in the year 1978. And today it is 94.81. Imagine. So what are the stages I've gone through from 1978 till now? All along in Forex. Trade only. So what's happening? This is impacting the global liquidity management. Maybe due to war, maybe there's a very poor management of our balance of payment in terms of flows, because we have been depending upon only one area, RBI intervention, which has been very poorly managed by Reserve Bank of India. Very, very poor. I'll show you. I'll show you with the numbers. And then what we have seen in the March 2022, from 2008 till 2022 March, the whole world enjoyed 0% or negative interest rate. When suddenly, due to higher inflation, the countries like US, right? Okay, the UK, and then Japan, then Europe, and all, they started increasing interest rate. And when they started increasing interest rate, all the banks, all the central banks, those who are holding dollar assets, all went into toss, revaluation losses, huge. In fact, if you ask me, the Reserve Bank itself lost a huge amount. And then how do they cover that? You see, that's a very poor risk management by RBI. They sold dollars from the dollars which they held as FX reserves and which they have been buying since 1992 liberalization. So they have started buying at 21.50, 24.50, 26.50, then 31.37 for a longer time, 37 very longer time. Went on, the holding rate was 60, 62, and then they sold at 80 something, and he made a profit, and they said there is no loss on mark to market of this securities. Second part. So this is the agencies. So I can share it later. The major part I would like to share is the Reserve Bank of India here, who is concerned with the authorizing the authorized dealers and money changers name, right? And the FEMA regulations, CRR, SLR management. I'll show you all this with the numbers if you want. Then DGFT foreign trade policy. So first the government did not announce from 2015 till 2023 the new policy. And 23 they announced and they said that this will become like your Bhagavad Gita or Ramayana, no changes. Only changes will come. Okay? So you will not get the new policy. Very surprising. Acha. Then now what is happening? This rule of FEDI, FIMDA, so many agencies they are there. So many agencies, people are confused. Okay? But then this is the way it is happening. No issues. Now, reserve situation right now, we have got $709 billion. Surprisingly, we have external debt of $747 billion. Now, if you look at these reserves, okay, every week, 5 o'clock, RBI announces this data. Every week, 5 o'clock, okay. So, let me see that today's number, which would have come right now, okay. Let me see if they have released today being Friday again. Okay, so yes, it has come. So, instead of 709, right now, unfortunately, it's not there right now. Okay, maybe later it will come a little bit. Fine, no problem. So this $709 billion reserves, what we are saying, we have built up over a period of time. How? Next question is that somebody should question RBI. Why you are accumulating by spending rupees from the reserves? Number one, this has got components of 3 components. One, foreign currency assets. Second, the gold. And third is SDRs with IMF. Imagine, you will be shocked if I tell you The gold reserves are not actual gold reserves. It's all because of the increase in the value of the gold, which has going on up to $5,000 went, right? So it's mainly because of, and why they are doing this? Because they did not cover the gold sovereign bonds issued by RBI. They did not buy the equivalent gold, and now they have to redeem at a high price. Who will bear the loss? RBI. But they will have it like this. Second, reserves. How you are creating these reserves? Foreign currency assets. You are selling assets to the foreigners. See, reserves, if you look at the China's reserve of something like $3.2 trillion, Japan 1.5 trillion, then again your Russia, Switzerland, all countries, they are building out of the trade surpluses. But we are making out of, despite the fact we have trade deficit. So what we are doing, we are funding, how we are funding the trade deficit, nobody is questioning that point. And how we are building the reserves for what? Or what is the reason for making the build? Now you see the deficit, trade deficit for this year till February was $310 billion. Exact number I'm telling you. And maybe as against 280 last year. And maybe it will be about $350 billion for this entire year, because now this March data will add. You see so much trade deficit, and the maximum trade deficit is with our enemy country, that is China. Okay, not more than $100 billion, $125 billion. And FPI alone outflow is more than $12 billion. See, so rupee is, then premium 3% has no relevance, I tell you, today if you ask me. Because people are not going to hedge it, the exporters are not going to hedge it. Okay, who will do this? Okay, so this is the problem, 9481. Okay, so what is happening is because of this US-Israel war, Russia-Ukraine issues, so many geopolitical issues impacting. And the worst thing is the 10-year yield, 6.88 something. Imagine, when the government itself is borrowing at 6.88 and state governments are borrowing at 7.5 to 8%. You see what is the situation? This makes enough life easier for the bankers to subscribe this and then borrow from RBI at repo 5.25, make clean spread of 1.5%. So what is the relevance of repo at 5.25? See, you are giving a bogus inflation number. Inflation is 3.21 something, you have got CPI, and this month's inflation will come to around 5%, I tell you. Okay? So if you compare this with US, with other yields, not relevant at all. So if your GDP, you are saying 6%, 6.5%, CPI inflation of 5% if you take March, because you have ignored the inflation. Surprising the data people institutions, how you are doing it. You are ignoring the inflation for considering the growth, GDP. I'm sure I'm telling you it will be a minus GDP, negative. Okay. So what is happening? Impact of this relationship is decreased trade volumes, high trade deficit, INR depreciation, which will follow higher inflation, supply chain fragmentation, goods, gas, fuel, fertilizers, increased cost, hard shipping, logistic, travel, insurance, premium, hedging. Yes, the boys who are going for studies abroad, how they will manage. Geopolitical disruptions, impact of FDI investments, capital market, interest rate, followed by the corporate delinquencies. Now this is going to result in many corporates who will not be able to pay your ECBs at 95 or 100 rupees. You see what is going to happen. So here the balance of payment management done by the Reserve Bank of India is here. If you look at these three accounts, current account, capital account, and the reserve account, we have had the huge trade deficit here. And the invisibles, which are mainly coming from NRIs and other remittances from NRIs, something like $130 billion. I'm not sure whether this year it will come, because many of the NRIs have come, or they have lost a job, or they are not interested to invest in India because rupee is going haywire wherever it is going. So they don't know what's going to happen. Okay, so part of the money was funded from the remittances to meet, and the remaining was out of selling our assets to the foreigners in the name of liberalization, either through FII, FPI inflow, ADR, GDR, ECBs and all. So we are busy selling our assets to the foreigners, let me tell you. And what are we doing? The excess is going to the reserves. We are able to sell more. Okay. See, I tell you, I I will tell you a small story which has happened with me once upon a time. I was earning 25,000 rupees a month. And my expense for the month was 30,000 rupees. I had a deficit of 5,000 rupees. So for me to fund that 5,000 was difficult. I went to the bank and checked all accounts, no money. Then tried to borrow, nobody gave me. Okay, then what to do? I used to wear a lot of rings. I went and sold one ring. I wanted 5,000, I got 10,000. I was very happy. I sold one ring and met the deficit. The additional 5,000 I kept as a reserve for future. Then what happened? Next month again problem, that 5,000 gone. Like this, in 6 months, all my rings gone. And after 6 months, again I was in deficit. Now what to do? Where to go? There was nothing. Now can you imagine? I had no past reserves, not able to borrow, no assets to sell. What to do? Then I have to sell my blood. Best option. Other could be, the God is kind, He has given two eyes, 2 kidneys, two, everything. So I could sell one. After selling all this one by one, then what is left after that? Nothing. See, I tell you, the same situation we are going through right now. There is no intention, no efforts to contain the trade deficit. No efforts are made. Whatever is happening to various schemes here, there, PLI, this, all bogus schemes. Because when you are 82 crore people are living on 5 kg ration, okay? So what's happening? Plus you are largely when at 20 crore. So this is the situation. Now look at this trade. This year's expected only $10 billion, imports $760 billion, trade deficit 350, funding NRI about have taken higher 130 billion. And what you are doing? You are mainly depending upon this because FPI inflow is zero, negative. And you see the highest trade deficit is in the enemy country, close to $125 billion. So what they are doing are swap, FX intervention. I'll show you that. So what the RBI does? Sundra, AC chalano? Bharti, AC. Bye. Bharti. AC. So here, this is a 3-tier system. Actually, all over the world, they follow the same thing, right? There is a central bank here. This is the interbank, and this is the exporter-importer. So money comes in, flow comes in when from the exporters, inward remittances. Flow goes out from here to importers and others. Now, if there is an excess, RBI intervenes and take away. They take away the dollars. Those dollars goes to reserves. FX reserves goes up. Then how do they manage the rupee? Because they are supplying rupees, no? They do the sterilization, INR sterilization by issuing the bonds. Now reverse today, when importers are demanding the money, okay, or other FPIs are demanding the money, RBI is selling those dollars from the reserves. But when they are selling the dollars, the rupee goes from the system, okay, to RBI. Then what do? They do open market operation, wherein they sell the securities, okay, they to in order to provide the liquidity. So this is the way it is happening. So now look at this. See, this is the intervention, what you call smooth forex volatility and boost liquidity. Indirect, first they do the moral intervention. They will talk over the phone with the dealers. Then directly, either they will buy spot, okay, or they will do the buy-sell swaps. So they will do sterilization, foreign currency swaps, near or forward, okay, right? So what they do here, I am going to explain you. Then money market to control the inflation and money supply liquidity, INR sterilization. OMO, buying or selling of GSEC, targeted long-term repo. MPC, they are only interested in CRR, SLR and repo rate, nothing else. So what do? So I have given a slogan with the election in West Bengal and other states. Abki baar, so ke baar. What RBI is doing? They are busy doing Badi Moon. Like Rashmika wedding, you would have seen that these guys are busy doing Badi Moon in Thailand. So why not to have in Mumbai? What RBI is doing? They are intervening in the spot and swap market. They are selling dollar from reserves, which is impacting the liquidity, rupees going from here. And then RBI is doing forward. Swap deals, buy dollar, spot, sell forward, and you will be surprised. There is an oversold forward dollar position of to the extent of $100 billion. So they are purchased it and they are oversold for future $100 billion. Imagine. And reverse is when supply of US dollar is more, RBI does INR stabilization for spot purchase of dollars. So rupees depreciated as of now today is about more than 10% in this year. And now effective, the changes in the FEMA 99 where the banks will be required to make the SOP and all from 1st October, it's not going to impact on BOP, let me tell you. Okay. What is my suggestion to RBI to protect the INR is stop accumulating reserves now onwards. Stop it. There's no need. Why do you need $700 billion here? Come on. So present FX reserves mainly on a devaluation of gold. RBI did not cover gold position, I told you, for a sovereign gold bonds issue. Now RBI realized that the banks are mis-selling insurance very late. I've been telling this for last so many years, 5-7 years. Not only insurance, they are mis-selling mutual funds also, especially to senior citizens, just for commission and overseas trips. At the cost of what? At the cost of their own deposits. Now you know CD ratio is over 80% and the scams here coming back is a bank and all. And they are paying high rate of interest to the FDs, 7% and plus and all, right? Why don't you sell some government offices? Now you have got new parliament, new offices, new Kartavya office and Luton's homes and all. Sell it off now all. Okay? Like, you see, a lot of money about more than $3 billion has come from RCB, RR sale, IPL team. Sell them, allow people to sell to the overseas parties, get some foreign currency. So as I said, RBI lost close to 1 lakh crore in MTM of GSEC in March 2022 because of increasing interest rate by major central banks in March 22. And RBI covered loss by how? They sold the dollars from the reserves. Okay. So this is the way the treasury in the banking works. Everywhere it is corporate also, same customer. They reach the branch, dealing room, integrated treasury, front office, mid office, back office. Now when I started in the year 1978, one person was doing all the job. One dealer, one. Now 3 people are doing the same thing. 3 people are doing the same thing, front office, mid office and back office. Right? And you have combined market together, domestic as well as global. Okay, so front is risk taking, dealing, actual dealing, risk management. So it is good in a way because it's good for. So what are the functions? Like first is reserve management, CRR, SLR, liquidity management, asset liability management, capital risk management. It's a beautiful thing, I tell you. RBI website is the best website for everything. And it has got everything, if you ask me. You check this here, policy rates in terms of repo, etc. You check in terms of your CRR and all. Everything is here. There is nothing which is not here in this RBI. So it's quite thing, which is available to everyone, like policy rate, reserve ratios, CRR, SLR, exchange rate, whatever it is. And more than that, the master directions, which I told you, the foreign exchange management. Now, what we have right now is a different master circulars, master directions for import of goods, export of goods. They are going to be combined from 1st October, together. So together you can see export and import, and you will find separate master direction for MTT, merchanting trade transactions. So a lot of business is happening in MTT also by buying goods from China and selling to other European countries or US and all. So we are doing some arbitrage or some African countries, but at the end of the day, we have lots of outstanding and issues with the EDPMS. Now they say from 1st October, all the MTT transaction will also be routed through the EDPMS, IDPMS. I don't know how, because when the goods are not touching India, how you are going to make it? So let's see, the banks are worried about SOP on these issues. Now you can see here, I've got a chart from 2011 till date, different dates, exchange rates, average rates for the month. So here itself you can see the rupees depreciated over 10% in this year. Okay. what is happening? Currencies, our balance of situation is very high, very bad, outflows, which is leading to depreciation. Crude oil, which is about 110, 115. Inflation may touch 505%, I can assure you, from March to 2026 onwards. So, currency with high rate of interest appreciating short term. 10-year G-Sec 688, I told you, banks are doing arbitrage. You will be surprised to the extent of about 7 lakh crores. I can show you the number right away. Close to 7 lakh crores from RBI website. All evidences I've got this. If you look at this here, straight away, they are 677. They are borrowing 5.24 average. Okay, then TREPS 5.22. So 522 and something like from RBI, totaling around 7 lakh crores. They are borrowing and then investing into G-Sec and other things. Very clearly given here. And you keep talking about growth, growth, growth. For what? Where is the growth you show me here? You are ignoring inflation. Okay? And then coming to the point. So this is all happening right now. The countries I have mentioned to you. At the end of the day, what is important is the demand and supply for the exchange rate. Now you see the gold situation, like reserves I showed you. China has got the highest reserves, 3.31. Okay? Trillion. This is out of trade surpluses. Whereas we have got trade deficit. We boost, we have got reserve. So why don't you tell me how you have made it? How you have accumulated? And where from the rupees come? Rupees come from the RBI reserve. Or printing the notes. You are creating supply. And then creating inflation. So your reserves are creating inflation. See here. The rates which I showed you. From 2008 till 2022, almost the interest rates were 0%. For almost how much? 13, 14 years. The Western banks thinks that they are not supposed to pay any interest to the depositors. They are getting free money. Okay? Like our companies, those are raising the money from capital market. They don't want to pay any dividend. So must be surprising. Sometimes I feel, why not? You know, when I started, people were thinking that why not $1 equivalent to rupee 1? Definitely not 1, at least it will be 100. So this is what exactly all about. And I tell you, the factors which I mentioned to you, all the interest, domestic inflation, capital flows, trade deficit, these are the various factors which is affecting the US China. So the major thing is the exposure. You see, the people are to have to understand, all our corporates, everyone, whoever is using foreign exchange or not using, they should understand the exposure part of it, the transaction exposure, economic operating exposure, or something on that of translation exposure, systemic risk. Right now, what we are going into the systemic risk, okay, due to this West Asia war. So you have to understand Incoterms, you have to understand that how you cover the non-LC business through trade credit insurance like ECGC and all, to cover the commercial political risk, protected default, right? Or through LC. Still, LC will not cover all these risks, whichever I mentioned to you. So let me tell you, Forex risk mitigation is the very simplest thing could be. Invoicing in home currency. Now see, effective from 1st October now, they are going to put rupee export you can realize in 18 months time. Now they are giving that time. Let me just increase this so that you all can see to it. Leading and lagging, okay, postponing or advancing the money, netting on natural hedge, no problem. EFC or PCFC. PCFC is the best way to hedge it. Best way to hedge without premium. Okay, and then you can have forward contracts, future contracts, options, currency swaps. Okay, importers can do through FCDL, FCTL, bias credit, suppliers credit. All are there. Okay. FIFDI investment, FRAs, rupee, you have so many things. Okay, and then you have capital markets. So we see everybody has to make the risk management policy. That's the point. I suggest you should follow that, practice it. At least has 50% here, whatever it is. Then coming to the market, I told you this regarding the valuation. Even the bigger banks, in the March 22, I know some signature bank, SCC bank, and even this from Swiss banks. They were merged among themselves, and then a lot of banks, about 4 banks, they failed in US. And there were about 30 banks. I was in US that time. About 30 banks was in pipeline for failure because they have not done any coverage, and they have been investing in US assets at 0.5% per annum, 0.5% usually. And when it went to 4%, and the people started withdrawing the money, they had no money to pay. Okay, and then when they started selling those treasury bills, US treasury bills, they started making cash losses. Okay, anything which ranged up to $80-100 billion. And 4 banks were in the closed, and the other banks were on the verge of closes, and then the Fed Reserve Bank intervened and helped them through Citi and JP Morgan and other banks, and then they could survive. So this gives a realistic. So everybody knows. This is like this. मैं जानता हूँ मगर मैं मानता नहीं. They are one-way traffic. Okay. See, you are allowing this. Now look at the mutual funds. I can tell you what are the 40 plus mutual funds. Almost 20-30 would be definitely in losses. So it's a right time to consolidate, merge them. In fact, not only mutual funds, a lot of export promotion councils are there, like few and all. 30, more than 31 plus. They are doing nothing except selling the training. Okay? They are doing the training, nothing else. So what? When the government is not taking their advice for the FTAs and other things, why do you want so many and then everybody has to pay? Like how these banks are paying to FEDI and FIMDA, they're every year 1 lakh rupee charges, and these people go and enjoy, have fun, Thailand and all. Okay? What's the point in this? Exporters paying to the export promotion council for nothing. See, you have this. Before I come to this, before I tell you, there is something called CCL. CCL has got an FX retail platform which is available free of charge. Let me tell you, this is FX retail platform, and you get the last rate here, last traded rate and all. If you look at this here, everything you get all the rates like 94, 85. Everything on money market, government securities, forex, derivatives, all the data you are getting free of charge. Why not to use this? Why to pay? I'm showing this my paid site. I'm not advertising this. These are paid site, and I'm showing you free also. So mark to market is very important to give realistic appraisal. So RBI says that you must do it for different things. Trading, investment in certain securities, preference shares, all. Okay? To show the current market value of these investments to the investors. Okay? And then what happens? You have to classify. What are those assets which are there need to be valued, like forex, spot, nostro, mirror, forward, future, cross currency, swaps. See how many things, remittances, you get it from monthly from FEDI, FBI, FIMDA website. Interest, BSC, really mark to market, fixed income, SLR, GSEC, SDR, T-bill, non-SLR, CD, CP, abstract. How many are there? STM, held to maturity 25%, SLR 23, non-SLR 3%. Okay, so this classification I just explained. Capital market, okay, metal and commodities, gold and silver. See, look at this. So here, what you do? You need to do this HTM, no revaluation. Available for sale, second category. Okay, do it quarterly. And then you can do fair value through profit and loss valuation. Could be done in quarterly or subcategory held for trading, HFT, valuation daily within the FPP. So bank to decide category of investment at the time of acquisition, buying the securities and recording the proposal. And investments can be shifted once in a year from HTM to other category, or other category to HTM once in a year in the month of April generally. And transfer should be at cost of book value or market value, whichever is based on the transfer.
Sir.
Yes. Hello. Somebody want to say something? Achha. So as I said, so these are the instruments which are there. Okay, so they like you can go for forwards, futures, or options, whatever it is, depending upon the need, right? Okay, and this is all theory only. Now I would like to take some questions, Basil. If you have any questions on this, you can ask me. Vasudha? Vasudha?
Yes, sir.
So this is rest all theory I am not covering. So if you have any questions, you can ask me. You participants can ask me now, or let us finish and then they can ask later.
Okay. If there's a question, we will discuss on the question and answer session, sir. Okay?
Okay,
Is it
fine.
okay? Okay, sir. Thank you, sir, for your insightful speech and informative.
No problem.
Okay. So, so now, let me introduce another esteemed speaker of today's webinar, CMA Dr. P. Shivarama Prasad, sir. Shivarama Prasad sir, a qualified professional in cost accountancy, company secretary, and have extensive experience in finance, insurance, and banking of 36 years of service with cross-culture experience and good knowledge in insurance sector. He is a fellow member of ICSI, the Indian Institute of Banking and Finance, Insurance Institute of India, and the Institute of Cost Accountants of India. He is former AGM of SBI, and presently he is the faculty of BFSI board.
Okay.
Shivarama sir?
Gupta sir, if at all he closed that PPT, then I will upload.
Yes, I've done it, sir.
Okay, sir?
Yes, I've done it.
Next
Anything else?
is,
Anything else? You can start sharing now.
particularly websites also.
Okay, I'll do that.
You click that one, sir, instead of each and every last button.
Have finished.
No, still it is there. Na? One by one is not required, sir. The total
Okay. Oh, complete out. Huh?
complete. Correct. Okay. Now the PPT is visible, sir,
Yes, sir, it is visible.
and PPT is moving or not? 1 minute. Why it is not moving? Stop sharing. Again, I will upload. Okay. Now it is moving.
Yes, sir, it is visible and moving also.
My voice is also audible.
Yes, sir, you are audible.
So, good evening to all professionals. The same topic, that is impact on global uncertainty in international trade. So, I will specifically talk on insurance sector. In international trade, the insurance plays a vital role. Whether it is an exports or imports, that is various risks are to be covered by the insurance companies. So thereby, the lot of impact is there on insurance, particularly with regard to the international trade. I will discuss in detail about all these things. The effect of worldwide uncertainty on international trade, focusing specifically on insurance sector or insurance industry. Everybody knows about the probability theory will be followed by the insurance companies. So accordingly, they will cover whatever the goods or services that are happened in the international trade completely to be covered by the insurance companies. Today, on account of a war, most of the insurance companies are going to be collapsed because the claim ratio is high side. Whatever their investments, whatever their profits will be eroded on account of the damage to the goods that are in transit, particularly to the different countries. So I will discuss about briefly on insurance sector, particularly with regard to general insurance. Thereafter, what is the impact of this war on international trade with regard to insurance? That also I will discuss. The importance of insurance in international trade. Insurance plays a vital role enabling the international trade by mitigating substantial risks. Whatever the various risks are there in the international trade, all are covered by the insurance. Otherwise, the jeopardize the transaction, cause severe financial losses. If at all it is not covered, the manufacturing or the traders or the service providers, they will face a lot of problem in international trade. So the insurance is a mitigation tool in the international trade. And once the insurance is not there, business operation will stop or halt. Beyond mitigation of risks for traders, these instruments are critically for lenders. Whenever the traders, international trade, that is exports or imports, the manufacturing companies or service, they are availing various funding facilities from the banks. Whenever they are funding, banks are funding, the insurance is compulsory. Today, on account of this war, both the banks as well as insurance sector is facing lot of challenges and problems also. I will discuss all these things. The key insurance types, everybody knows about this key types, particularly in international trade, are: one is marine cargo insurance, covers loss, theft, or damage to goods during transit. Either it is through sea or air or land, including loading and unloading incident. So during this transit time, if at all any losses are there, all are covered with the marine cargo insurance. Today, insurance companies are not willing to provide that policy on account of the war. Export credit insurance protect exporters from non-payment of the foreign buyers. The importers, they are going to buy the products, but on account of this war, this coverage of risk also they are not providing to the exporters. To the commercial risk, insolvency and bankruptcy, and political risks like war, trade embargoes, or currency transfer restrictions. Other political risks also covered by the insurance companies, particularly general insurance companies. The protects against the loss of government actions, such as nationalization, exportation, or sudden change in the import or export policies. Product liability insurance, that is also international trade, covers export if their products are caused injury or damage in the foreign market. And custom bond and insurance guarantees the payment of duties, taxes, ensuring the smooth clearance of the at borders. For all these risks, once the goods are exported to other country, up to reach the product at a destination and release the goods by the particular importer, whatever the various risks are there, all are covered by the insurance company. Today, this business is a high risk business on account of the war. Once in the coming days, claims one by one, particularly the marine claims or exports and imports claims, one by one, if at all paid by the insurance, their capital will be eroded and most of the companies may fall into sick or closed also. Importance to lenders in financing. One of the prerequisites particularly while lending to the exporters or importers by the banks or financial institutions. Insurance is must. Without insurance, they don't finance. Once they don't finance, how they will export or how they will import the goods? Banks are sort of thinking about to mitigate the risk. They don't simply they're providing the funds to the others. Lenders are highly sensitive to the risks involved in international trade, such as the goods of failing to arrive or they arrive or buyers failing to pay. All these risks are to be covered by the insurance companies. If the conflicts or this type of a war and uncertainty is there, definitely no insurance company will provide the policy and no banks will provide the loan also. Thereby, it affects on the international trade. Risk mitigation. Insured shipments ensure that the event of total loss, the ship sinking, or lender can recover the value of the financing. So all these things, the insurance companies, if they provide, then only the lending will happen. In future, on account of heavy losses, definitely these policies, either it may be withdrawn by the insurance companies or the premiums may charge higher. Once the premiums are charged higher, particularly the MSME sector, the insurance premium is also very costly for them, and the spread, the profit will also decrease. Improved borrowing capacity. When the foreign account receivables are covered by the credit insurance, lenders are more willing to include these exporters' borrowing base, thus expanding to access working capital. Counter-cyclical function. The trade credit insurance also absorbing during the economic downturns. So, export continuity when bank lending might otherwise contract. So, once the banks are giving funding to the exporters, then only the trade will, international trade will increase or our forex reserves will increase. Once the risk during that particular export of goods is not happening, how the banks will give the loans? Once, if at all the insurance companies are charging a high insurance premium, then it is the business is not profitable to the exporters also. Impact on non-coverage. Okay, if at all non-coverage is there, no insurance, goods are simply sending to different countries, but that is also not good. If appropriate insurance is not in place, lenders may refuse to provide finance. As the lenders is exposed to buyers' credit risk, country risk, that is country's government restrictions, currency exchanges, and all these things are there. And dangerous to fraud also. Now, this is the basics of the insurance, particularly with regard to the international trade. Now, the lifeline of international trade is insurance protection for goods and services. Whatever the goods and services that are exported to different countries, that is to be properly covered the insurance. Otherwise, goods movement will not happen. Lending institutions will not fund to these companies. On account of this one, now the insurance companies realize how to overcome this problem, whether to stop or to continue, or if at all, the particularly during war, number of the exporters, they face a lot of problem. They have submitted some claims to the insurance companies also. If all these claims are paid, then all are in red figure. The insurance companies are in red figure. The effect of a conflict involve Iran or Israel and the United States on the particularly insurance sector. How this war is the implications are there on insurance sector. The contemporary geopolitical tensions involving Iran, Israel, and United States introduce significant uncertainty in the global economic systems, particularly affecting international trade and the insurance sector or insurance industry. So, the correlated both the international trade and insurance sector or insurance policies are correlated. Definitely, it is correlated. Once the risk is more, uncertainty is there, insurance companies will not cover that particular policies. The marine routes, airspace, or financial channels face disruption. The insurance sector has emerged both a risk absorber and a transition channel to the economic stress. So now they realize whether to continue the marine policies or hull policy or the various types of risks that are there in the international trade, whether to continue or not to continue. Now the insurance companies are rethinking about this one. The multi-dimensional impact of the war-related uncertainty on marine insurance. If marine insurance is not given or not covered, banks will not finance. So it is particularly the insurance is a compulsory one. Reinsurance markets. So after the share capital, most of the insurance they will issue the policy, whatever the capital base is there. Beyond that, they will always sell this insurance to the London market. Now the reinsurencers also, they are also thinking about whether they will take that particular reinsurance from the other countries or not. They are also thinking, because on account of this war, the reinsurance companies are also incurring losses. Export credit guarantees and solvency margins. What is a solvency margin? The solvency margins are stipulated by the Insurance Regulatory Authority of India based on the coverage, based on the risk, how much capital is there. The broader stability of the international trade. So these are the war-related uncertainties there. International trade is deeply dependent of geopolitical stability. If a political stability is there, there is no problem. The insurance companies will not face the problem of risk. Otherwise, the risk will be there. Once a risk is there, claims will increase. Once the claims are paid, whatever the premium they are collecting, that is not sufficient to meet the claims. Insurance, especially marine or war risk insurance, serves the backbone of the global commerce. And the global commerce, the trade, the mainly depending upon the insurance sector by enabling the safe movement of goods across borders. So whatever the risks they are forecasting or predicted to mitigate that particular risks, the insurance companies are issuing the policies. And conflict in strategic regions like Middle East, particularly involving Iran, Israel, and the US, pose a significant threat on shipping lines, energy supplies, particularly gas, or financial markets also. This disruption's cascading effect on insurance, reinsurances, banks, exporters, and importers. So, on account of this uncertainty or conflicts that are arising in the Middle East, the cascading effect is there on the banking system, the financial system, the insurance sector, the reinsurance sector. That is a prominent one is London reinsurance market, and exporters. If at all they wish to export the goods, they should also mitigate the risk. To mitigate the risk, only alternative available for them is insurance policy. Once the insurance companies are not issuing the policies, how they will mitigate the risk? And the importers worldwide. The Strait, Hormuz, and Red Sea are among the most strategically sensitive marine corridors. Today, that is the biggest problem. Whether any missiles are used, then automatically whatever the cargo, whatever the ship, all are damaged. Whatever the amount, small amount the insurance companies they are getting by way of a premium on that particular transit, then it is very difficult to pay the claims also. Any threat to these routes increases operational risk for shipping companies, amplifies the exposure for insurance underwriter, marine and cargo risk also. So the threat is there in these routes, increases the operational risk, particularly to the shipping companies, amplifies the exposure for insurance underwriters also, marine and cargo risk, global trade exposure, geopolitical conflicts. How it is happening? Particularly substantial portion of a global oil shipment containerized trade passes through the Middle Eastern waters. Military tensions in the region, probability of attacks of the commercial vehicles, port blockades or sanctions, and the cyber war, the particularly targeting the logistics infrastructure, that is a big threat on the insurance sector. So once they targeted that ship and under war clause, they have to pay the claim. They have to pay the claim. They are taking the premium very less, but the claims are more. Even take for example one car, the value of the car may be that 12 lakhs. How much premium they are taking? 10,000 or 8,000 or 9,000 like that. If completely damaged on account of fire, the car for 8,000 premium they have to pay the 12 lakhs rupees. Like that, the particularly marine or cargo insurance or premium is very less, because they are predicting that risk will not be there. Today, everybody realizes that there is a lot of risk in the international trade. These factors disrupt trade flows, raise freight charges, reduce the predictability necessary for efficient international commerce. So once these conflicts are more, definitely it disrupts the trade flows, reduce the predictability, unnecessary efficient international commerce. In the coming days, the only one alternative is available: importer substitution. So we need not they import the goods from other countries. We have to manufacture, or if at all oil or gas is there, any natural resources are available within the country, that is to be explored. Otherwise, in the coming days, this is a big risk also. When uncertainty rises, exporters face delayed shipments. Today, on account of a war, most of the ships are halted, and thereby, once a delay is there, if at all it is a perishable good, okay, leave it of the oil or gas. If at all it is a perishable good, it will damage. Once it is damaged, the claims will be raised by the exporter to the insurance companies. If the policy is covered that particular the transit insurance also. Contract breaches, payment risk, importers struggle with the supply shortage of price and volatility. Because today the international trade, whatever the various risks are there, all are covered by the insurance companies through marine or hull policies. Insurance policies covering marine cargo, political risk, trade credit or triggered more frequently in such conditions. Marine insurance rise in war related claims. Definitely, that a lot of impact will be there in the general insurance companies. The premium is recovered is less, the claims are crores. The balance sheet size is not absorb whatever the claims there is. Only one simple example, for 12 lakhs car, how much you are paying? 9,000 or 8,000 like that. For 8,000 rupees. If damage has happened to the car, 12 lakhs to be paid means how much funds are required for the insurance companies? Marine insurance has the most directly affected line business during geopolitical conflict on account of war. Across the world, the insurance sector, lot of challenges and problems are there. Losses definitely almost all companies next financial year 25, 26, 27. If you see the balance sheets, the losses will increase on account of a payment of claims. War related claims typically arise from physical damage to vessels. Something that is happening in at Iran also. Seizure of ships or destruction of cargo or liability of environmental damage caused by oil spills or explosion. For all these things, coverage is there in the marine insurance. The physical damage to the vessels or a seizure of that particular ships or a destruction of cargo or a liability of environmental damage or the oil spills or explosion, all are covered. War risk coverage, which is usually offered add-on standard marine policy, become critical during this period. That's why some of the companies, they stopped not to include the war. Some of the companies, if the goods are traveled through the sea zone, particularly in the conflict zones, they are not covering. Claims under these policies have increased due to missile attacks, drone strikes, hostile naval actions, and high-risk maritime zones. That's why now they have taken choosy manner. They are only covering only within the country whatever the domestic costs are there. Even some of the companies, particularly whether it is Iran or Israel, whatever the insurance companies are almost all close. Why? Because the balance sheet size is very, very less. The claims, destruction of cars, destruction of houses, all these things, they are unable to pay that one, unable to pay that amount. That's why simply that is to be leave it like that. Example scenario, particularly if you see the one example, a tanker carrying crude oil valued US dollars 80 million struck by missile while transiting conflict zone. The incident results hull damage, the ship damage, cargo within the ship, whatever the goods are there, and the environmental. Once the fire is happened, particularly if at all it is carrying oil or gas, then automatically environmental problem will also come. For that also coverage is there in the insurance. The combined claims of hull cargo liability policies may exceed US dollars of 60 million with a significant portion of transfer to reinsurers. Once the capacity of the insurance company is not up to the mark, they will sell the insurance policy to the reinsurance. Today, in the world, the reinsurance market is the best market. London market is there. Now they are also reluctant to purchase the reinsurance. Escalation of war risk premiums and insurance contracts. Once the risk is more, the premium will increase. Once the premium is there, the insured person, particularly the exporters, they have to pay more. Once they have to pay more, then automatically their profits will decrease. So that's why escalation of war risk premiums and insurance costs. War risk premiums are highly sensitive to geopolitical developments. In stable conditions, such premiums are minimal. If at all there is no war, conflicts are not there, the premiums are minimal. Now, like increase in the gold rate, the premiums of insurance company premiums will also definitely will increase. However, during the period of conflict, insurance rapidly increase the premium to reflect the heightened risk, because the risk is more. Once the risk is more premium to be paid. In extreme cases, premiums may rise to several percentage points, not 1% or 10% or 20%. Even if the premium is raised at 200%, 300%, we need not astonish. Vessels insure for a single voyage. Okay, these increased cost, particularly to the exporters and importers, leading to higher landed costs, goods and inflation pressure in importing the countries. Small and medium enterprises disproportionately affected as they lack of a financial capacity to absorb a sudden increase in the insurance and flight charges. Withdrawal of the risk, particularly withdrawal of the war and marine, the insurance coverage. Some of the companies already started. No, we don't want to cover marine. We don't want to cover the various risks that the goods are in transit. Insurance contracts often contain war exclusion clauses, allowing insurer to cancel or restrict when the risks become manageable. So sometimes the insurance companies also, they will give 7 days notice. No, we are cancelling that particular war clause. Today, almost all companies, they have issued that guidelines, that information to the insured person. No, we don't want to cover the war risk. That is the exclusion clause. In conflict zone, insurance may issue 7 days cancellation notices or declare specific marine areas excluded zones. When insurance withdraw coverage, shipping companies may unable to operate. Once the shipping companies are also the hull insurance, the shipping companies are also now, once insurance is not there, how they will operate? The movement of goods will not happen. Port authorities and financial required valid insurance coverage. If at all any financial institution bank they wish to provide, provide finance, the insurance is compulsory. This leads to temporary collapse of trade. That is the problem. So the cascading effect or side effects are more. Is affected routes until alternative insurance arrangements are secured. Reinsurance market stress and loss accumulation. Even London market is the best market. They are also stopped this one because we don't want insurance policy. Reinsurance plays a critical role in spreading catastrophic risks across global market. War-related losses are typically reinsured due to their severity and unpredictability. Okay, reinsurance market also now they stopped. Why should I take? Why should I pay the huge claims? Whenever I am taking peanuts and I have to pay the more claim, they are also reluctant. However, the multiple incidents occur within a short and the same geographical area. Reinsurance faces accumulation of risk. Accumulation of risk arises when severally insured assets are exposed to the same perils simultaneously. For example, multiple vessels are passing through that narrow maritime corridor may attack within a days, resulting cluster of large claims impact on the same reinsurers. If 100 or ships are moving in that particular zone, if any attacks are happening, then it is a huge loss to the reinsurance. This concentration losses may lead to reinsurance price hardening. Even reinsurance people also, they are increasing the insurance premium several times, reduce the capacity, stricter underwriting terms for the primary issues. Impact on ECGC. One of the in India for exports and imports, Export Credit Guarantee Corporation (ECGC) is there. They are covering different policies. That will also be a problem. And the whole turnover packing credit advance is there. That is also a problem. And particularly Export Credit Guarantee Corporation of India provide insurance to exporters and banks against non-payment risks, etc., etc. Now today, it is a big problem to ECGC also. In conflict scenarios, importers in affected regions may default due to economic instability. Once the importer receives the goods, once the war is going on, how he will do the business, how he will manufacture through the imported goods or raw material, logistic disruption. As a result of the claims, export credit insurance increases, placing financial pressure on ECS and leading to the tighter underwriting standard exporters of the high risk. Next, solvency margins. Particularly general insurance companies, they have to maintain the solvency margins. Today, on account of this one, solvency margins are become thinner. The claims are more, the capital is less. The insurance regulator require companies to maintain a minimum solvency ratio and policyholders' obligation. A surge in claims due to war-related events, insurance to strengthen their technical reserves, reducing the availability. And if solvency ratios are fall below the regulator, insurance may require additional capital. Restricted dividends, they don't pay any dividends, then automatically the prices of that particular insurance companies in the stock market will also fall down, reduce the underwriting exposure. This regulatory pressure insurance policyholders protection, but also contains the growth and profitability of the insurance companies. In the coming days, down the line, if you take 5 years, most of the insurance companies will incur the losses. Their shares are also quoted low rate in the particular stock markets also. And prospective investors, they don't want to purchase the insurance shares also. Loss in other segments also. In the Middle East, particularly, airspace closures are also there. And the airlines to reroute flights over long distances. This increases the fuel cost, operational risk, exposure period, leading to higher aviation insurance premiums and potential claims. Even not only the marine, but aviation insurance are also covered by the insurance companies. That also the big problem. Political risk and property insurance. On account of war, the residents, the buildings, as well as the cars, all are the damage. Multinational corporation operating in conflict regions may experience. Take for example, Google data or Amazon data centers are also damaged. Now, if they claim the insurance companies unable to pay the claims also, that type of their policies, their claim amounts are big, the premiums are very less. Political risk insurance property triggered resulting additional loss for insurance. Impact on investment portfolio. So the insurance companies to pay the claims, they want to sell out their particular investment like bonds or shares, debentures, purchased from different companies through that particular premium. Now they want to sell it. Once the sales are increasing in the stock market, then it impact on the stock market also. Insurance companies invest a premium income in equities, bonds, and other financial instruments. Geopolitical conflicts cause stock market volatility, currency depreciation, and fluctuation in bond yields, etc. These market movements lead to investment losses, further weakening the insurance financial also. Okay, okay. Within 10 minutes, I will close this one, sir. Supply chain disruptions, extended risk exposure, and on account of this one, supply zones may route vessels to longer routes. Particularly, some of the ships are moving longer routes like Cape Good Hope. Thereby, the transit time will increase and other risks will also increase. Decline in trade volumes of the premium. On account of this one, insurance business will decrease, and once it is decreased, then it is a problem to the insurance companies also. Whatever the fixed costs are there, that will not incur. All these things, lower demand of a marine policy and other things are there, and the strategic response of the insurance. These are the strategies they have to take: increase in the premiums, sublimits of war, or sublimits they have to restrict, policy wordings have to be changed, reinsurance arrangement, and risk modeling. All these things are there. So, Indian export goods to Israel. Due to missile attack, shipment is delayed. Israel buyer faces the financial distress. The exporter unable to receive the payment to invocation of ECGC export credit insurance also. These are the side effects that are there. To conclude, the Iran-Israel-USA conflict highlight the deep interconnection between the geopolitics, international trade, and insurance markets. There is a connectivity is there. Insurance serves the financial backbone of the global commerce. Its stability is essential for maintain trade flow during the period of uncertainty. However, prolonged conflicts strains insurance system through increased claims, capital erosion on account of a payment of claims, reinsurance stress. Sometimes reinsurance companies will also not purchase, reduce the premium income. All of the side effects on account of tensions, on account of uncertainty in these zones. Thereby, it affects a lot on international trade. The resilience of the insurance industry, such scenarios depends upon prudent risk management. Now they have to raise adequate reinsurance support, and some cases government is also to be provided funds. A global trade becomes increasingly complex, interconnected the role of insurance in mitigating the geopolitical risk and continue to grow in importance. So this is in brief about what I wish to say. There is a connectivity between the international trade and the insurance also. Today, most of the insurance companies they are not selling, they are not offering, they are not covering the marine or the aviation or hull policies, etc., etc. So, thank you very much for the initiative for giving an opportunity to discuss about the topic. Thank you, sir.
Thank you, sir. I think we had an exhaustive presentation by our Shivaram Prasad, sir, and everybody is waiting for our third speaker, and we welcome with all our welcome, sir, Mrityunjay Acharya, sir. He is coming for the first time for our BFSI event. Welcome you, sir. Just sir would be speaking on the insurance and reinsurance in the present global uncertainty. To just brief profile of CMA Mrityunjay Acharya, sir. Sir is a fellow member of our institute and also an associate member of ICSI. He has completed his graduation and post-graduation in commerce from University of Calcutta and also MBA Finance. He completed postgraduate diploma in tax management from IIM Bangalore. He is having more than 34 years of industry experience in leading industry house in our country like FAIL, Bharat Electronics, SEBI, Delhi Stock Exchange, Baman Lorry and Company, and presently is working with Numalika Refinery Limited, which is under the Ministry of Petroleum, Government of India, and serving as General Manager Finance. He was a guest faculty at various Indian universities and premier B schools over the period, and presently a guest faculty at IIM Kolkata. Also, he has written various multiple publications, premier publications like GST law and procedure, direct and indirect tax laws. With this small introduction, I uh, request sir to start his presentation and welcome wholeheartedly for today's session, sir.
Uh, Thank you,
Over to you,
and
sir.
very good evening to all of you. Am I audible?
Sir, a little less, sir. You can increase the audio volume, sir.
Yeah, I just change it. I think this is over. Just check it up. Otherwise, I have to use this thing.
Yeah. Now it is okay, sir. You can
Now it is
start.
okay. 1 second more. I'll just put the slide in the screen. And Dipindu, you confirm me whether it is visible or not.
Yes, it is visible, sir.
Let me put it in full screen. Okay. So, and how much time I do have?
Sir, now it is 6:34. Half an hour you can do, sir. After that, we can have some question answers and then close the session.
I'm keeping the stopwatch ready with me. Thank you, my predecessor, my co-speakers in this particular session. And thanks to BFSI for giving this opportunity to speak on a most emerging issue on the reinsurance strategies or reinsurance market across the world and how it is actually getting affected in the geopolitical uncertainty and the present economic situation. Not only in India, across the world, and how it is having the impact in our country and particularly in the industry. What I precisely will take up next couple of minutes time that is allotted is particularly what is the impact on the industry, not going into the theoretical discussion and others, how it is actually impacted, because this is the particular time lot many companies, including the oil and gas companies in our country, who are actually going on a roadshow and completed just their insurance coverage policies, meeting with the reinsurers, meeting with the reinsurance market across the world. While Dubai is also a big market, but in this particular time, Dubai is not operating. So Singapore and London, what is the impact? What are the turbulences being seen? And what is the net impact going to come to an Indian industry? Because ultimately it is the cost which is the industry need to bear. That's only is my point of discussion in this particular forum, and followed by after say next 25 minutes, I'll keep the forum open to get any questions in this regard. Right, and Dipindu, you please or BFSI board backup people, if you find anywhere any difficulties in the presentation or the discussion mode, please give me a call. Then I will change it accordingly. Okay, so fundamentally, reinsurance is something like the backbone. So why it is not moving? It is moving. So fundamentally, this is the agenda of today, next 25 minutes. Overall, an idea of the reinsurance industry, which couple of years back also, for the most Indian industry counterparts, it was not very well known. Insurance companies definitely are having the treaties with the reinsurers, but for the Indian industry per se, this is something like a black box, and very rarely we used to had a direct access to big and the best MNC REs like Munich RE or Swiss RE or Everest, etc. But last few months or last 1 year, the situations are getting changed. India becomes a hotspot, whether it is a gift city or IFSC or Bombay, BKC, these are the places are getting flooded with the reinsurers. India becomes a hotspot for the reinsurers to do business, because they find this is a place where they have the business, and this is the way Indian industries are going to gain out of it. How and which way this current year oil and gas industry as well as power industry like NTPC or other companies, how they are moving ahead with some practical example. I'm just to the extent I am no I can afford to say that much only will speak on this particular forum. Other things, other agendas are there. Let us see how the time permits and how the time allows me to speak on all this particular point on the reinsurance market. But fundamentally, it is to understand that whenever we find insurance, what Shiva sir was explaining, I'm thankful to him. He given a very, very vivid conception of the insurance and how its impact on the Indian industry or any industry for that matter. Fact remains, whenever there is a risk exposure, whenever there is a risk that need to be covered under an insurance coverage, and if a single point of loss comes out to around 10,500 or say 12,000 or say 20,000 INR or Indian rupees, crore Indian rupees, right, which is basically fall in the definition of mega policy, which is more than 2,500 crores as per the definitions. So there require a question of whether the insurance company, do they have the capacity to underwrite such a huge risk, or they need a support of some other persons globally. In India, there is the GIC is the reinsurer. But apart from India, there are a number of the global reinsurers who understand or try to understand the business of the Indian continent or Indian subcontinent, try to find it out the risk exposure, right, to find it out that what are the risks, challenges, catastrophic risks, the nat cat risks, and all other perils, and based on which they find it out a particular rate which should be the commensurate to the risks that they underwrite. So this fundamentally, this underwriter or reinsurers are located in 2 or 3 particular pockets of the world where they have the expertise or super expertise. What Shiva sir was telling is London market, definitely yes, Lloyd is the biggest one, and Southeast Pacific, now the Singapore is the emerging one, and possibly Southeast Asia. Singapore is particularly serving the Indian continent. And I had the opportunity last week only for more than 10 days. I was in Singapore with the meeting with the reinsurers, having understanding that what's the actual position of the geopolitical situation prevailing in the world, what is its impact that's actually coming to Indian industry, and how Indian insurance industries are rebuilding its strategies, how the RIs sharing the risk patterns or underwrite the risk patterns, how the lead is getting determined, the lead reinsurers, and how the follow market actually operates. Okay, so not going into very, very the jargons or big words like FSE, FAC, and the treaty agreements, which some other day, next occasion, we will discuss. Fundamentally, these are the industry which has a rapid and tremendous growth across the world. Something which is being shown on the slide. I'm not repeating for the sake because everybody is able to see it. It's fundamentally gives a concept that where the Indian domestic insurance industry, like the largest one called the New India Assurance, or the smaller one like IFCO Tokyo and others, when they find out that there is a risk they are going to underwrite or going to undertake, then definitely the burden they need to shift it to the reinsurers, RIs across the world. Okay, big RIs, and interesting. What most interesting, IRDA changes the regulation that has been changed. Government of India is playing a very, very pivotal role in the entire process of bringing the entire globe into Indian segment. Today, to meet the Munich RE or the Swiss RE or Everest or Sompo, we need not to go abroad. In Bombay, in BKC, or in IFSC, in GIFT, we're able to meet them. We are able to, discuss with them. We are able to had a overall concept analysis whether the market in the world is softened or hardened. That means soften or harder means whether there is a tremendous demand for a insurance and reinsurance that determine the price. This is again a price competitive market where the market determines the price of the particular product. So if if there is a big catastrophic incident somewhere, some part of the world, or if there is a big fire in some of the oil sector or some of the gas bunker, some part of the world, where these reinsurers are actually undertaken the risks or underwritten the risks. So if they are exposed to the extent the underwriting they have made, obviously for the next stage, the market become big tough, because all of you understand it is a commercial sense, demand and supply. If the capacity is fully utilized and then further requirement comes out, the rate inflates or rate increases. And if the rate increases, the Indian domestic industry has to accept that particular rate and give a rate to the particular Indian industry, which may be an inflated rate. Okay. Before going ahead, one concession let me clear to all my professional friends, with the permission of two my co-speakers in this particular forum, that even a couple of years back, we in India, except the insurance companies, I repeat, except the insurance companies, never had the direct access to these RIs, excepting somebody has access to the GIC, because we only used to approach to the insurance companies, and insurance companies used to provide the rates and other, to the extent the sum insured and to the extent the single point of loss concept or deductible, as the case may be. Different factor that influences the including the geopolitical, that influences the global RI rates or global RI business strategies. Few things are there. I'm not going to repeat what is written, but fundamentally, if there is a catastrophic incident somewhere, in short called as in the insurance language called as NatCat incidents takes place, and the NatCat zone in India, the different geographical area are divided into different NatCat zone. Okay, some of the area which is prone to earthquake EQ, or which are most prone to the flood or any other such natural calamity, they are marked with a particular zone A, B, C, or 1, 2, 3, etc. Wherever there is a catastrophic risk, with that the geopolitical risks and the geofragmentation, that also becomes very important for the RIs to play, to determine their risk exposure and what's the rate that should prevail for that particular industry which is located in that geographical area, having a catastrophic impact, or maybe are exposing or possibly going to expose with the geopolitical risks. Right. On the marine side, Shiva sir has said a lot, many discussed in detail. So I will not touch upon the marine insurance side, but you can find it out. There are other emerging areas that's globally coming up. One of which is the cyber insurance, and it is taking a very, very significant role to play. I just give one example and then go ahead, that how the risk is perceived in this particular segment. Just one example for a few seconds only. We feel that cyber is required for protection of our data or data center or some sort of a server, etc. Very recently, in India, one of the company, I'm not telling for the sake of the secrecy, I'm not repeating the name, but one company's name came out in the newspaper called as Oil India Limited, whose entire setup was hacked. Similarly, there are a number of companies, basic data center is hacked, and followed by ransom. These are another stories that we can discuss in some other occasion when we will discuss only on cyber. But what is interesting, only one point to share, that cyber is not only to extract the information. It is something like a dangerous thing may happen, that a refinery or a in the business is operating at a particular rate. Okay, at a particular operating process, the IoT, the Internet of Things, which is moving in a predetermined way. There are certain temperature is set or pressure is set for certain activities or certain process industries to cover. If the operating server is hacked, and due to this hacking, The control panel will continue to show the temperature as 200 degrees centigrade, or the pressure of, say, 3 times of the atmospheric pressure. But the actual operations, the temperature never remains 200. It may move on to 400, which never reflects on the control panel because the entire SCADA system is hacked. So what is being displayed before the operating engineer, operations head in the control panel, and what is actually happening are totally different. It may, or it tends to go up in a big blast in a refinery, or in a gas bunker, or in a power sector, okay, without actually implanting any bomb inside it. Cyber is moving into that sort of a threat. Cyber is providing that sort of a threat, and to understand that risk, what may prevail in that industry, the cyber, how much it can cover, what will be the risks, what will be the exposure, how much Indian industry may cover, how much it should underwrite abroad, how much people will take abroad, what are the protections, what are the firewalls, etc., etc. Itself is a big study, itself is a big area for the reinsurance industry to penetrate and operate in our country. It's a big subject. Some other occasion we may have a discussion on the cyber. So the reinsurance market is particularly, once again, is moving with so many other dynamics like microeconomic, the interest fluctuation, the forex fluctuation rates, market volatility, the changing customer experiences, technology changes, systematic risks, unsystematic risks, exposures, war perils, etc., etc. So these all put together, when a product is provided to them, it's like they need to understand, the RIs need to understand what is the exact quantum of risks. I give an example. For a energy industry, Indian energy industry, in oil and gas sector, total amount of asset or property, both my course speaker will understand this language called PD damage. The PD value is 50,000 crores. But but there is a single point loss concept, that if the loss arises in a particular point, what will be the maximum single point loss may happen? That may go somewhere, say 15,000 crore rupees. 15,000 crore, if we take the list of the IRDA or the insurance companies who are in the IRDA, the gross domestic premium or gross domestic written premium of the top 10 industry are almost in that particular region of 10,000 to 12,000 crores, excepting New India Assurance. So that way, if somebody undertake entire 15,000 crore rupees the risks, they will be exposed to the entire thing. If something, God forbid, takes place, the company will be simply washed out. That's the requirement of the RIs in our country, or any country for that matter. Okay, the market trend, take very short, very quickly. I try to cover up the factors which actually influences the RI into the Indian concept or global concept. For example, a destruction or a fire in some of the Latin American refinery, which doesn't have any bearing on the Indian industry or Indian petrochemical industry or Indian petroleum or pharmaceutical industry, doesn't have any direct bearing. But for the RIs, it becomes a direct impact, because they had got an exposure totally. There may be a lead who has taken the lead exposure. There are followers who taken the follow-up exposures. For them, the capacity starts reducing. The moment the capacity gets reduces, right, it becomes a rate fluctuation. And the moment there is a rate fluctuation, it impacts on the domestic industry to suffer into it. So it impacts on the capacity and the capacity utilization, how much capacity you do have, how much you have actually utilized, how much you have with the free capacity, how much you can provide for the exposure, and what is the risk into it. What is the quality of the risk? What is the quality of the risk? Is the risk quality is very good or risk quality is poor? how much you are going to actually take the shoulder the risks into it. What are the driving factors that influences the market? What is the profitability and how much you are going to the pricing? What is your pricing? That's the biggest challenge for the reinsurer, because their pricing actually flows into Indian market, and Indian insurers are following up, taking that particular rate and then quoting it to the Indian industry. The regional dominances, the catastrophic dominances, the product type, what type of risk product, and the emerging risks like AI or cyber. These are the facts which are actually evolving. For a matter, for one thing to clarify, for them the product is the risk they are playing. For them the product is the risk. How much risk I should buy and what is the rate for buying, right? How much risk I should absorb and what is the rate for that. And if I am not alone going to take the entire risk, then how it has to be shared with my followers? What is the predetermined policies? Who is going to shade before and who is going to shade it from the back end? What is the global rate that is prevailing? Okay. Fundamentally, these are guided by what I have just said in this slide. The risks on the risk appetite. Some of the European RIs are not that much of risk appetite, where some of the Southeast Asia Pacific region oriented RIs, China based, Hong Kong based, Singapore based, they are becoming too aggressive nowadays. So their risk appetite is more because of some reason, because of the geopolitical pressure, because of the socio-economic pressure, because of the pressure of the economic situation of Japan, where the economic growth rate, GDP growth rate, is very, very low. The companies are moving out and they are going to have the business, so the risk appetite is more, the rate is less. The different strategies, every industry wise the strategies are different, whether it is a marine, whether it is a oil and gas, whether it is a coal based thermal power, or whether it is a power transmission, whether it is a steel plant. Okay, the insurance strategies are different, that all determined at one single concentrated places what is the centralized property and the stock that is being concentrated and what is the catastrophic effect thereon. Okay. 2 minutes, 3 minutes. I know my previous speakers have spoken on the geopolitical situation, on the war perils and etc. Already this has been discussed, so I will take only a few things which has not been discussed so far, or which is not taken up from the RI's point of view, not from the insurance point of view, but from the RI's point of view. Okay, so in the what the RIs, the reinsurer are going to take is basically on the different war situation. So even war is moving on, there is a direct impact on the marine perils, the war peril on the marine transaction. What Shiva sir also has said, that insurance companies are taking out their exposures there, and they are coming very clearly, no, we are not going to cover the war exposure in the entire insurance risks. Correct. But the other risks which are already prevailing, how that has to be managed and that has to be entered upon. Okay, it is not going up. Marine, obviously it has been covered. Damaging things are happening. It becomes a cost enhancement for any of the Indian industries. Rising cost of marine, it has to be, because they have to move their entire journey for so long from the from South Africa, right, instead of the Middle East. Cyber threat and other, all we have said. Only one point I should keep before I go to the next slide, and maybe time is also not permitting, is that understanding the complexity of the insurance and in the cyber situation. Okay, all together we had a mindset that there is a property, and the property may be damaged because of fire, because of earthquake, because of flood, or because of some sort of incidents. There is a terrorism policy. which also covered the terrorism activities, right? But the single point terrorism policies, which is actually backed because you can understand. Say today, India, most of the part of the country are not covered by the terrorism activities. It was definitely there a couple of years back. I'm speaking most of the part. So terrorism also you can understand, you can determine, you can foresee, you can focus. But what you cannot is the cyber threats. And it's no longer story, no longer Hollywood movies. It's an actual real fact. There are situations came out where the hackers, they took a control on the entire control matrix of the SCADA system of a power generation unit, okay, or a gas generation unit, and then asking for ransom or asking for certain threats into it. Okay, these threats and other thing on the marine, I'm not repeating for the sake of time that that need to be saved. Only couple of minutes are remaining for me. Okay, what is the shift in underwriting? What is the shift? What is the tendency in the underwriting market or in the RI market? That's my last point of discussion, and then I will keep the house open for discussion. Ma'am and sir, when the world is in a difficult geopolitical disturbed situation, India recorded is one of the most stagnant and most economically growing economy in the present situation. If you take the southeast, whether it is Japan, Philippines, even Australia, it is sliding down. China is almost stagnant. Russia is getting disturbed from this way, that way. Middle East is in a turmoil. Europe is declining. So in that event, India becomes a hotspot so far as the industry, so far as the insurance, and so far as the allies are concerned. Marine has gone up a huge cost because of the Red Sea, the Middle East position, moving around across the world to reach to Europe. But fact remains, these global REs or RIs, reinsurers, having a huge capacity. They are in the business. And this is the particular sense we received while having in Singapore, even last 2 days before also. We had a wonderful concept that these people want to have a business. They have to be in the business. The, the safest zone found out India. And the industry is moving up in India because of so many factors, the statistics. Interestingly, I will tell you, these particular RIs are moving at a CAGR rate of 10%. In Indian context, 7.8% CAGR growth over last 3 years. Such a wonderful movement is taking place in this particular industry. So what is being said? That the portfolio distribution, the risk distribution are comparatively in a better position. The risk qualities are better, and they have a huge capacity abroad. If these people support Indian domestic industry, which are actually going to happen or actually happening, I am not taking the name of one of the Maharatna companies whose entire insurance project just got completed 7 days before. The rate has come down drastically as compared to the previous year. One of the Maharatna oil and gas company, only 7 days back, they have completed the entire process for the next year. The rate has come down. It is not because of the Indian industry, Indian insurance companies. It is because of the RI who has got the excess capacity, finding a good risks. The qualities are very good. Threats are minimum. Catastrophics are minimum. Wars are zero. Terrorism is zero. The rate comes down. And these economics of determining the risks and finding out the rate for that actually helps underwriter to quote the rate for that particular industry. And that actually shows the process. Before I close, I think I have already covered the time. If time is still available, Dibyendu can tell me. Otherwise, what I only say, even this is not working.
So you can continue, sir.
So, There are this screen, some of the screens I am putting, high severity, and there are certain metrics being done. I apart from the RI, one point I'd like to share here in this particular forum, because we are speaking from the Institute of Cost Accountants of India. Literally, I found out while working with these RIs or insurance companies that how to determine the value of the property, what is the determine the value of the risks. Okay, I have got a property. I have got a property which need to be covered. What is the risks of it? What is the valuation of the risks? Is it the market value? Is it the intrinsic value? Is it the future value? Or is it the value as per my peers or as envisaged by a foreign multinationals? Valuation exact for the purposes of I and RI, insurance and reinsurance, is a very, very important area where we are particularly doing an enormous job silently. From the industry, even I am doing it. I believe, like me, there are other persons in ONGC or Indian Oil Corporation, Bharat Petroleum, NTPC. I'm just speaking few names, are exactly doing the same thing. This is the area which need to be looked into it. And the government of India permitted all these RIs to come in India. 100% FDI is now permitted. Every company, whichever name you say, they have all come in our country, some part, particularly West, Maharashtra and Gujarat, they have already established. This is a particular time where institute should make a bridge between the industry, between the institute and these professionals to boost up the opportunities that we can provide, that support that we can provide in the RI industries. Okay, last one or two, since some more time is available or given to me. It's like the policy wordings. The RIs are the best persons. They need to find it out what are the best policy wordings, so that at the time of the actual claim, you can provide the support from them. Okay, rapidly going through the risk transfer, how the risks need to be transferred, and in this last issue is that in this emerging present market situation, when there is a everywhere, today, any part of the country, you will find it out, there's a huge crowd outside any petrol pumps. Okay, for getting petrol or diesel. There is a scarcity of the gases, natural gas. There is a scarcity of other product, and people find it out the export market, if it is the major Indian rice which is exported to Iran, Iraq, and Saudi, this particular zone, if the export is hampered because of the geopolitical situation, the industry is getting affected, the insurance is also getting affected. It is like insurance is a service, is providing a service to the main industry. In that sort of a emerging industry, when there are severe disturbances in some part of the world which leads to actual real loss across the universe, but Indian industries are going to gain or actually gaining, and they are gaining because of the rate, because of the statistics, no theory, because of the statistics. The companies, the big corporates are getting a gain because the RIs find India more comfortable. Valuations are perfect. They have a dependency of the Indian valuation concept and the Indian risk perspective, which is a much better quality risk. This all put together in one nutshell is the advantages of India today to approach this particular segment, invite them more, and to make India more sustainable and more Atmanirbhar in every aspect. And in this journey of Atmanirbhar, we definitely, from our our future outlook should be like that. We should have a global hotspot of RI market in India, and the institute should play a pivotal role in this particular field. Thank you. I'm closing. I have taken some
Thank you.
minutes time
Thank
more.
you. Thank you, CMA Mrityunjay Acharya. We are very attentively listening to your deliberations. I understand that this is I think this subject of reinsurance could be one of the very important, segments of our BFSI board. I request you to please advise us so that we can really take up this matter more intrinsically, so that our members can be benefited out of this, because a lot of opportunities are there. So today, really, we have got an excellent session which has highlighted key economic tensions. Already our speakers have used real-world examples for impact and poses strategic questions to spark debate among our cost accountants, bankers, and insurers. And this navigation of the storm, how the global uncertainty is reshaping international trade, what cost and management accountants must do. So all these things have been discussed, and I understand that definitely we as a CMAs stand at the forefront, thus with quantifying the unquantifiable and steering enterprises through this fog. And CME Ittunjay Acharya has given a food for thought that we have to capture this. Whenever the challenge is there, there is an opportunity. So it's an opportunity for our cost accountants. I understand that with our expertise in activity-based costing, scenario modeling, we are holding the keys. We must pivot from reactive ledgers to resilient strategies, dynamic pricing models that hedge currency flux, blockchain tracked supply chains for transparency, and ESG integrated cost forecasts that anticipate regulatory tsunamis like the European Union's carbon border adjustment mechanisms. So, with this, I understand that today's session has been really very impactful for everybody. I request CMA Dibyendu Roy to please address any questions which have been received from our, respectable audience. Kindly push it to our faculties so that faculties can really satisfy them with their replies.
Thank you, sir. I think I am checking the chat box, sir. As of now, there are no pertinent questions, but anyhow, sir, we can take the questions after the session also. And I think with this today being an auspicious day of Ram Navami, we close today's session. And I thank all the eminent speakers for today for their excellent session on covering various aspects of this global uncertainty in international trade. I thank CMA Chittaranjan Chattopadhyay sir, our chairman of BFSI board, and our speakers for today, starting with CMA Nijay Gupta, CMA Dr. P. Shivaram Prasad, and finally CMA Mrityunjay Acharya sir, for making this session a very thought-provoking session. And we'll upload this recording in our YouTube channel for everybody who have missed today's session because of the pujas and other things, so that it can be a value addition for their future discourses. With this, we close today's session. We thank you again for your valuable presence. Thank you all.
Okay, thank you. Thank you. Namaskar. Thank you.
Thank you, sir. Sujata, you can close the session.
Dibyendu, thank you.
Thank you. Thank you.
Thank you.
Thank you.